What you said is true. What all of the people you cited have said is true. It hasn't manifested itself in much, much higher prices, but that doesn't mean it's not true. It just means that price has been controlled in the West. And I really do believe that that is something that is ultimately, not just in gold and silver, but all of the commodities, is a privilege that is going by the way of the dodo bird here for the West. And you're going to see more and more and more price setting and price settlement leave the West and move towards other arenas, whether it be the East or the South or even fintech 24/7 settlement. I think we're moving in a direction that could be fairly significant. And to see it bust out of that falling wedge pattern could very well be the beginning of this significant move. I guess only time will tell.
Global commodity markets are reaching a decisive turning point as physical bullion breaks out of a long-term falling wedge formation. Decades of artificial paper price control across Western derivative exchanges are steadily losing leverage against undeniable physical fundamentals. Andy Schectman, president and founder of Miles Franklin, asserts that price discovery and settlement mechanisms are permanently moving eastward. He projects that the rapid expansion of 24/7 fintech settlement rails and tokenized precious metals will soon channel an unprecedented wave of crypto capital directly into tangible bullion. When this incoming digital adoption converges with aggressive central bank accumulation, physical silver and gold prices will be propelled to massive new highs. As confidence in paper contracts evaporates, physical delivery demands will completely overwhelm paper short positions. This structural transition toward physical settlement represents the beginning of a generational commodities supercycle. Now, we present the clips from Andy Schectman's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
When you see China buy more silver than at any time in the history of their country over the first quarter and huge amounts the second quarter as the price has been going down, this is the second largest producer of silver in the world. And in essence, they're thanking the market for lower prices. From a technical standpoint, it's fairly significant. We have seen a falling wedge pattern, as it's called, and a falling wedge pattern gets more narrow as it gets down towards the bottom. And if the move breaks either way, it has potential to be fairly significant. The fact that it broke out through a falling wedge pattern from a technical standpoint is very bullish. But look, the public doesn't really, they have the right to be cynical in this kind of analysis. You look around and you see, well, it's not hard to get silver in the industry. So why is everyone saying that, what's the deal with silver? Why isn't it priced higher? Why can you still get it? First of all, this is when we're talking about the setup that you're hearing from these folks. We're talking about there's the falling wedge pattern, and as it broke through, that's a big move right there. That's significant from a technical standpoint. But look, the bottom line is that forever the price has been controlled in the West under the assumption that no one stands for delivery. This has been challenged. It's being challenged. And the COMEX is losing significance. Price discovery is moving eastward. At the highest level, getting industrial-sized bars in large quantities is becoming more challenging without spooking the market. And I think that we will see prices continue to move higher. That's not why you buy it. And I don't know how many times I've said that. You don't buy silver to become wealthy. You buy it because it is wealth. It is a critical mineral. It is becoming more and more obvious to the very, very sophisticated traders. Gold and silver are far more important and far more relevant than the price would dictate. And, I did an interview today with a man named Paul Barron, who I'm very good friends with. Paul, I'm very fond of him. He's a very smart guy, but his focus is largely in the digital space and focusing a lot on how we are now beginning to see fintech companies, big ones, get into tokenized silver. Now, what I really, not that I want to focus on tokenization, but simply to say we would then potentially be unlocking a massive wave of buyers who haven't looked at gold and silver. And he said to me something very interesting. He said, Andy, I didn't look at gold and silver as money. And I wouldn't have ever believed it until the last several months when I've been researching this trend of tokenized gold and silver. And he says, I'll be damned. It's money. And the similarities between the thought process between the crypto community and the physical metals community is a lot closer than one would think. And so what I'm beginning to see is not only do we see institutional demand increasing at every level, not only do we see smart, very sophisticated central bank buyers buying it as the price has been going down and whoever's been standing for delivery here, regardless of how much is left COMEX. But I have a feeling that we are getting to the point very quickly where you are going to see a wave of buying from the digital sphere who is now really keen all of a sudden on tokenization of gold and silver and becoming aware, finally listening to the argument instead of being divisive of the two arguments and of the two industries. They understand it's actually quite complementary. So that, along with a further awakening at some point, probably unfortunately via some sort of an event that wakes up the mainstream. I would suspect this next time, not only will you have the push of the industrials and the institutional investors and the central banks, but a wave of the public buying in multiple fronts, physical and tokenized metal. I think the wave is just beginning on that front. So look, what you said is true. What all of the people you cited have said is true. It hasn't manifested itself in much, much higher prices, but that doesn't mean it's not true. It just means that price has been controlled in the West. And I really do believe that that is something that is ultimately, not just in gold and silver, but all of the commodities, is a privilege that is going by the way of the dodo bird here for the West. And you're going to see more and more and more price setting and price settlement leave the West and move towards other arenas, whether it be the East or the South or even fintech 24/7 settlement. I think we're moving in a direction that could be fairly significant. And to see it bust out of that falling wedge pattern could very well be the beginning of this significant move. I guess only time will tell. M2 is a measure of inflation, not the stupid CPI, which doesn't measure most of where all this money is going into, and those are assets. Yes, the cost of living is going higher, but all of this money that M2 is pumping into the system is going into assets, stocks, precious metals, real estate, all of these things that are making it unaffordable for young people to afford a home or to just, further down the line, just make ends meet. So we've been conditioned to believe rising prices is inflation. No, an increase in the money supply is inflating the money supply. Look at M2. And so if you print, then the people who are your creditors who are lending you money say, well, you keep printing, your dollar is becoming worth less with each print. We demand more interest. Well, if you cap those rates, that pressure has to escape, and it will escape in much higher prices, which will also run headlong into the oil-based higher prices that we have and experienced that from manufacturing to shipping to just flat out energy. So yeah, these are interesting times to say the least. And that is a Chinese curse. I wonder where this ultimately goes because they keep trying to plug holes and you wonder at what point do you just not have enough fingers and toes and the market forces, the natural market forces take over. And the old saying that all manipulations end badly is true. And when you have a whole global system that loses confidence in the current fiat system, when that happens, watch out. And when you see the Federal Reserve doing this, not to bail out Japan as much as it is to bail out the illusion of this super strong and liquid treasury market that everyone has always given me a hard time about who pushes back against BRICS. Well, we got the strongest treasury market. Well, do we? When we can sanction Russia for doing what they do, even though we do things like invade Iraq 23 years ago and we're still there under false pretenses, no penalties, or we can tell the largest holder of our debt, yeah, it's really not a good time for you to sell. So instead, tell you what, you're going to lend it to us for a small interest fee, and we'll give you those dollars back just so you don't blow the whole thing up. Well, is it as liquid as it is portrayed to be? When there's a big redemption, I don't know. I'm just saying it just doesn't feel right done again. And I think, I hate to be that little boy who cried wolf. I'm the poster child for it, but I'm also very glad to be an American. And I'm praying and hoping that through all of this, we are attempting to reindustrialize this country and bring back manufacturing and slowly find a way to produce more than we consume, because on the path that we are on, where we consume more than we produce, and we don't have enough in terms of revenue to even pay the interest on the debt, really, and start paying things down, there's going to be a day of reckoning globally. And I think you can see that as the infrastructure, this global infrastructure of settlement systems, payment rails, vaulting systems, bilateral agreements, all of these relationships and agreements and payment systems are moving to the global south, and that will have a consequence at some point.
Surging M2 money supply growth reflects the true reality of persistent monetary debasement, funneling excess capital directly into tangible assets, real estate, and hard commodities rather than traditional consumer baskets. As uninterrupted currency creation erodes purchasing power, foreign sovereign creditors insist on higher bond yields to offset ongoing inflation. Any central bank intervention to artificially cap interest rates simply forces acute inflationary pressure into manufacturing, international shipping logistics, and primary energy sectors. Simultaneously, the perceived liquidity of sovereign debt markets relies heavily on bilateral repurchase agreements and emergency liquidity backstops rather than organic demand. With independent payment rails, physical vaulting networks, and bilateral trade corridors flourishing across the global south, consumption-heavy economies face an unsustainable systemic imbalance rooted in compounding sovereign obligations. Now, let's get back to the interview.
More selling than buying the whole way up. It was the central banks pushing it up and the speculators on COMEX. It wasn't the retail public. So not only did you have massive selling, moving up at the same time, margin increases went up by 300%, which would make a 5,000 ounce contract 15,000 in margin in December, 54,000 4 weeks later in January. So you had to continue to post higher and higher and higher amounts of margin all the way up. At the same time, the ETFs the first 2 weeks of January rebalance. So if you don't post margin, you get sold, or you sell to get within margin requirements. The ETFs are guaranteed to sell to rebalance the first 2 weeks of January to the mandates of the prospectus. You had the 2026 allocations coming in for all the primary distributors, who are mandated to buy hundreds of millions of dollars of all of the major mint product and deals that they have with private mints and refiners, massive amounts. You had the refiners shut down because they were getting margin called on their short positions to offset what they have already bought and are working on. So they're market neutral, but the price was going up so fast and the margin requirement, they shut down. They're a big source of liquidity. So put it all together, you get a perfect storm. ETF rebalancing, margin increases, massive public selling, 2026 allocations, all culminating at the exact same time. And it created an environment that massively, and the refiners, by the way, which was a huge source of liquidity, which massively destabilized the industry. I've never seen it like that before. To me, it's an outlier. I believe, and that's what I was kind of getting at, this next time there'll be an awakening. And I believe there will be virtually no selling. It'll be the opposite. It'll be people who have noticed it from the periphery say, you know what, I'm done with this crap. This is all smoke and mirrors. I need to buy some gold and silver. I believe that because I've never seen selling like that. And in talking to people, it was, I'm out, I'm done. It's too volatile for me. It's blah, blah, blah. Those people are gone. And who's held left, I think, is strong money that sees things clearly. So I think you'll be able to sell whatever you want. Just like we saw during the pandemic, when we would pay you, of course, no one wanted to do it. And you can vouch for me on this, Dunnigan, $9-10 over spot on junk silver, $10-11-12 over spot on silver eagles. We would pay you almost 200 over spot on gold eagles. We would pay you so much higher than it had ever been. And of course, you don't get the people asking these questions. Then the antithesis of that is what we saw here. Both were outliers, but we added 14,000 clients in 45 days when Silicon Valley Bank failed, and they were bailed out illegally, not bailed in. If there is something that a lot of us see coming, feel it, that wakes up the public, this time it will be the antithesis of what we just lived through. You probably won't want to sell, but if you want to, there will be more than enough demand to sustain probably much higher premiums, much, much higher, certainly than what we see now, and maybe even to what we saw then, because I think there just isn't enough supply. if even a fraction of the public wakes up to the way I think they will. Those premiums on either side, we can't hedge. We can only hedge the metal price. So as those premiums go way up and we have to buy product to be able to sell, if what we saw at early 24 with the mint, or late 23, I don't remember, but it was right after the banks failed. Oh, the mint mysteriously came up magically with 4 million silver eagles, and the premiums went $9 over spot my cost, or 9.5 to $4 over it, and we lost $500,000 on 95,000 coins that we had just bought, hadn't even received yet. It was a June or July allocation, and that's money dead. There's nothing you can do about it. So I understand the dilemmas, why people left, and felt disgusted by it. But there were some guys out there, even David Morgan, who I love and respect, and I consider him a friend. He said the gold market didn't do well by the investors. But I think it's important that you understand, everyone out there, that this was an anomaly that was a perfect storm. And when you take the biggest dealers on the planet, the primary distributors who are taking brand new allocations that are being hammered with the public selling as the cost of margin goes through the roof, this was a distortion to the downside, every bit as much as the distortion to the upside for 3.5, 4 years when no one could get enough product because the premiums were too high because the demand was off the chart. So, we're kind of in the middle of all of this. So all I can say is I believe we will see markets go much higher in terms of premium with not much in the way of demand. Like, for example, if you look at the 2026 Silver Eagle mintage, it's very small. And again, another person I love dearly, Big Swear, talked about the mint not making it, kind of called him out. Well, I called a couple of my buddies that are primary distributors, and I said to them, let me ask you a question. Is the mint not producing them, other than your primary first 2026 allocations that you have to take, is the mint not producing the 2026s as much as normal? Because is it demand? Are you loaded up with backdates? Or is it a supply problem, a structural supply problem? And he said, no, it's more along the lines of all the primary distributors are loaded with product. So that's why it's so hard for the public to understand when these people say this stuff, that there's a scarcity at the highest level. And there is. The retail public has had squadouche to do with where the price has gone. But it starts at that level. And just like that, because it's a just-in-time market, and as all of the stuff that is in stock bleeds out, it's kind of the same thing about, the oil problem. Yeah, it's we haven't seen it yet. But if a little bit of demand will manifest in lack of production, lack of new product, just simply because there hasn't been the demand up until now. Maybe that'll increase, but here we are already going towards the third quarter. Normally we see product tightness in October, November. So as the mints transition to the next deal. So, I'm not saying that that's going to happen, but I could see it happening very quickly. And especially if things get out of control with the markets or some other swan that's flying around that we don't see.
The recent downward volatility across precious metals was engineered by an extraordinary convergence of technical anomalies rather than genuine fundamental weakness. Paper futures exchanges witnessed extreme 300% margin requirement spikes, elevating maintenance costs on a standard contract from $15,000 up to $54,000 within a single month. This dramatic liquidity squeeze forced commercial refiners to suspend operations when hedge positions were abruptly margin called, instantly eliminating a vital source of market liquidity. Compounding this friction, major exchange-traded funds executed mandatory portfolio rebalancing according to prospectus mandates, creating forced institutional selling. At the same time, primary distributors absorbed massive mandated annual mint allocations, while retail investors panicked and liquidated secondary inventory. This severe downward distortion created an artificial bottleneck across a fragile, just-in-time distribution ecosystem. However, physical gold and silver represent foundational wealth and vital industrial raw materials rather than mere speculative trading instruments. While secondary retail inventories temporarily masked wholesale physical tightness, wholesale supply chains remained strictly dependent on immediate industrial delivery. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.